Are you actually financially safe, or just comfortable right now? If you suddenly needed cash this week, not next month, how quickly could you get it? And if the market dropped hard tomorrow, would you be in control or forced to react? Because in a real crisis, your biggest risk isn't losing money, it's needing it at the worst possible time. Most people look financially stable right up until one bad week forces them to sell at the exact moment they shouldn't. That's how wealth disappears, not slowly, but in decisions made under pressure. And here's the part nobody thinks about. You don't need a world war for this to happen. A market shock, a job loss, a liquidity freeze, that's enough to expose everything. Which is why this isn't about predicting extreme scenarios, it's about understanding something far more important, the order of your financial decisions. Because when uncertainty hits, the sequence matters more than the strategy. What you do first determines whether you stay in control or start making irreversible mistakes. And the worst part? Most people don't even realize they got the order wrong until it's too late to fix it. Here's the mistake almost everyone makes. They think the goal in a crisis is to invest fast, when in reality, the first goal is to not be forced into a bad decision. And that sounds simple, but under pressure, it's almost impossible if you're not prepared. Because when panic starts, logic disappears, and that's exactly how people lose years of progress in just a few days. People don't follow plans, they react to fear. They start checking accounts constantly, refreshing headlines, feeling like they need to do something just to stay in control, and that's the exact moment they make the worst moves. So before we even talk about investing, understand this. The smartest move in uncertainty isn't aggressive, it's strategic. And strategy starts with one thing: control over your own money. Not returns, not growth, control. Because if your money is stuck in the wrong place, delayed when you need it, or locked when everything is moving fast, you're not making decisions anymore. You're reacting to limitations. Which is why the first step has nothing to do with investing, and almost everyone gets it wrong. It feels too simple before it costs them the most. The first step almost everyone misses is shockingly simple, and it's the thing that determines whether you stay in control or panic when the world moves fast. It's liquidity, cash or assets you can access instantly, not tomorrow, not next week, today. Imagine this. The market crashes 30%, your investments drop, and you suddenly need money for essentials, but your cash is stuck in a fund that takes 3 days to withdraw. Or your brokerage freezes transfers. That delay alone can cost more than the crash itself. Your portfolio is useless if you can't access your money when you need it. Liquidity isn't about flashy returns, it's about survival. About keeping options open while everyone else scrambles. And most people skip it because cash isn't sexy. It doesn't look impressive. But in a real crisis, it's the difference between staying calm and being forced into disastrous decisions. Here's the kicker. The smartest order of money always starts here. Everything else, investing, growth, assets, comes after this. Most so-called investors get this wrong first, and it costs them more than any market crash. And the next step is even more critical. It's what protects that cash and ensures you never have to sell at the worst moment. Stick around, because this is where most people completely fail. Step 2 is where most people finally realize that liquidity alone isn't enough. You can have cash ready, but if it isn't protected, it can disappear when you need it most. That's why an emergency fund isn't optional, it's your safety net. Picture this, you have cash in a checking account earning nothing, and suddenly a medical emergency, car repair, or job disruption hits. One emergency can wipe out months of careful planning in a single day. Without a proper emergency fund, you're forced to sell investments at the worst possible moment, or take on high-interest debt just to survive. Your emergency fund should cover 3 to 6 months of living expenses, enough to handle real emergencies, but not so much that your cash sits idle, losing value while you wait. This balance ensures your money is ready when you need it, without sacrificing growth potential. Here's the truth. If you protect your liquidity, you gain freedom of choice. Every investment, every strategy, every growth plan becomes intentional instead of a gamble. And the next step is where you start growing that money safely without risking the foundation you've just built. Stick around, because this is where most people fail and where the smart move separates the winners from the panicked crowd. Step 3 is where most people start thinking about growth, but if you jump too soon, you're setting yourself up for disaster. Chasing growth too early is the fastest way to erase years of progress overnight. This step is all about stability assets, investments that preserve value even when chaos hits. Think low volatility options, treasury bills, or gold, or other safe instruments designed to hold their worth while markets swing wildly. Picture this: your cash is safe, your emergency fund untouched, but your volatile stocks are dropping fast. Without stability assets, a single market swing can turn months or years of careful planning into panic and regret. With them, you stay in control, breathing while everyone else scrambles. Here's the core principle. Liquidity gave you access, the emergency fund protected you, and stability prevents catastrophic losses. That's your foundation. And now comes the part where most people blow it. The step where you can actually grow your money aggressively, safely, because your base is secure. Stick around, because skipping this step is exactly where ordinary investors fall into fear, mistakes, and losses, while the smart few turn chaos into opportunity. Step 4 is where most people freeze, while the smart few make their move. This is opportunistic investing, buying when everyone else is panicking, but only after your liquidity, emergency fund, and stability assets are secured. Because here's the brutal truth: if you skip the first 3 steps, one bad week can erase years of progress. Take 2008, for example. People who were over-leveraged panicked and sold at the bottom, losing everything. Meanwhile, those with cash and safe assets bought at rock-bottom prices and came out ahead. Picture it: the market tanks, headlines scream doom, and people dump everything in a frenzy. Your cash is ready, your emergency fund untouched, your stability assets safe. Now you can buy quality assets at a discount while the panic-stricken majority is trapped. Most people see crashes as threats. They panic. The wealthy see the same crash as a chance. When everyone else is losing, you're positioning yourself for gains they can only dream of. Opportunistic investing only works with a bulletproof foundation. Skip it and you'll freeze, or worse, you'll sell at the bottom. Follow the order, act decisively, and the chaos that terrifies most becomes the opportunity that rewards the few. Step 5 is where most people fail silently. They might have liquidity, an emergency fund, stability, and even opportunistic investments, but they ignore how much risk each asset carries. Overexposure to one sector, one stock, or one type of asset can wipe out years of careful planning in a single swing. Risk management and proper allocation are not optional. They're survival. Picture this: you bought during a panic, but all in one volatile stock. The market keeps swinging, and a single drop erases gains. Meanwhile, those with cash and safe assets spread investments across cash, bonds, equities, and alternatives sleep well. Their losses are contained, and their opportunities multiply. The key principle: growth without protection is gambling. Smart wealth isn't about luck, it's about balance, strategy, and risk awareness. Once this step is mastered, you protect your gains while staying ready for opportunities. Step 6 is monitoring and rebalancing. Your portfolio isn't a set-and-forget system. Check positions, adjust allocations, and maintain balance without panic. Ignoring this quietly erodes gains. Step 7 is cost and tax efficiency. Fees, hidden charges, and poor tax decisions silently destroy returns. The wealthy don't just make money, they keep it by managing costs and optimizing moves. Most people ignore these steps and lose years of progress to friction alone. Combine monitoring, rebalancing, and efficiency, and your foundation is truly bulletproof. Once liquidity, protection, stability, opportunistic investing, risk management, monitoring, and efficiency are locked in, you're ready for the advanced sequencing stage. Step 8 is advanced sequencing. The wealthy don't just follow steps, they sequence every dollar, every move in layers. Think of it like building a house. You don't decorate the roof before the foundation is solid. Sequence isn't optional, it's a hidden multiplier. Most people ignore order because it feels too simple, but that simplicity is lethal. When you layer liquidity, emergency fund, stability, opportunistic investing, risk management, monitoring, and efficiency correctly, uncertainty becomes opportunity, not threat. Skipping or rearranging steps turns control into chaos. Once the sequence is embedded, your decisions become predictable, safe, and strategically optimized. Step 9 is where most people fail quietly without realizing it. They follow the steps for a few months, maybe a year. Then impatience, temptation, or stress sneaks in. This is where mindset and discipline separate the prepared from the panicked. It's not enough to just have liquidity, an emergency fund, stability, or the ability to invest opportunistically. You must make the sequence automatic, so fear, FOMO, or sudden shocks never force mistakes. Habits compound faster than returns. The wealthy don't check markets obsessively or chase trends. They trust the order, follow it consistently, and let the system work for them. Discipline becomes the invisible shield that protects your wealth, even when chaos hits. Daily rules matter. Examples: I never touch my emergency fund unless it's a real emergency. I review opportunities only on scheduled days. When your stocks drop 20% overnight, you don't panic, you act strategically, because your habits already protect your plan. Step 10 is the final payoff, the complete, smartest order to invest and grow your money. Liquidity, emergency fund, stability, opportunistic investing, risk management, monitoring and rebalancing, cost efficiency, sequencing, mindset, and discipline. Follow it, and even a chaotic market works for you. Ignore it, and years of planning evaporate. Picture this: the market drops 30% overnight. Most panic, sell at a loss, and cry, "Why me?" You act strategically. Your liquidity gives options. Your emergency fund protects you. Your stable assets prevent forced sales. Your habits keep you calm. You buy, protect, and stay ahead while everyone else scrambles. Fortune favors the prepared. The smartest order isn't optional. It's the difference between stress, fear, and lost opportunities, and confidence, control, and long-term freedom.